chances are you're paying for something that you're not even using. The Federal Reserve Bank isn't a bank. The longer you let your money sit there and invest and compound, the more your money is going to be able to grow. Now, I make money by talking about how I was supposed to be a doctor. What's up, everybody? I am Jaspreet Singh from theminoritymindset.com, where money minds rethink rich. Saving money is not fun. I mean, when you save money, you have to earn money, and then you take a piece of it and you do nothing with it. But it is very important for a healthy financial lifestyle because you need to know how to save some money for investments. You need to know how to save money for emergencies, and you need to know how to save money for a big purchase. And in this video, I'll put together some of our best clips that will help you save money quickly. So let's get into it. I grew up in a traditional Indian household. My parents are immigrants from a state in India called Punjab, and they're some of the hardest working people that I know. But since I was a kid, they always taught me the importance of working hard, being honest, and becoming successful. Now, I don't know how it is for you, but in any Indian house, the definition of success is very simple. It comes down to a very simple equation. Success equals being a doctor. If you become a doctor, you are by default successful. If you go out and you ask any Indian mom out there, the solution to becoming successful at anything is by becoming a doctor. If you want to make a lot of money, be a doctor. If you want to be happy, be a doctor. If you want to be healthy, be a doctor. If you want to get married, be a doctor. But now, if we dive a little bit deeper and we define what the success is as financial success, now things look a little bit different. Now, I know there's a lot of different definitions of success out there: being happy, having a good family, being physically healthy, being mentally healthy, having a purpose. But for the purpose of this video, I'm going to be talking about financial success. So now, if the goal is to become financially successful or wealthy or rich or whatever you want to call it, if the goal is to become financially successful, is the solution to become a doctor? Well, becoming a doctor teaches you how to diagnose a sick person, how to take care of a sick person, how to do a lot of things. If I was sick, I would pay a doctor a lot of money to treat me. But being a doctor doesn't necessarily mean that you're going to be financially successful. Being a doctor means you are qualified to treat other people. At this point, every Indian mom watching this video is saying,
"Oh, Jaspreet's just saying that because he's not smart enough to be a doctor."
And yeah, that might be the case. But if you want financial success, the solution is to be financially educated. Because if you're financially educated, then you have the resources and the knowledge to use your money to become financially successful. This is how the majority of people, probably something like 90% of the population, manage their money. First, you make money from your job. You get a paycheck. This could be $20,000 a year or $2 million a year. It doesn't matter how much money you make. You make money from your job, and the first thing you do is you put this money in your bank account, and then you start spending this money. So you got your home expenses, you got to pay for your car, you got to go buy some clothes, you go on a vacation, you spend some money, and then that's why I got this dotted line here. If there's any money left over, you save this money. Now, some of you might be better than others at saving. You might not spend too much money, that way you can save more money, but for the majority of people, this is how their finances look. You make money, then you spend a lot of it, and if there's anything left over, some of that money gets saved. If you're wondering, "Oh, Jaspreet, how do you know how people manage their money?" Well, just look at the numbers. 1 in 5 Americans do not have $5,000 saved up for retirement, and 7 out of 10 Americans, the majority of Americans, don't have $1,000 in cash saved up to protect them from an emergency. What the minority of people do is they start by smashing that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. So if you hit that button, I will very much appreciate it. But what the minority of people do is first, they get paid. So let's assume for this example that you're getting paid from a paycheck again. Now I'm gonna go right to left this time. This time they start by saving money. So you put some money aside for your savings first. And then you invest some money. So you put some money aside, then you put some money to work for you. And after you save and after you invest, that's when you spend. So it's a different order of events. The difference here is the majority of people make money, they spend their money, and then if there's any money left, that's when they save it and that's when they invest it. Wealthy people, the 1%, what they do is you make money and then you save it and you invest it first, and then you only spend what's left after saving and investing, because investing and saving is what's going to build your wealth. Investing is going to build your wealth even more. Savings is really protecting your wealth, but you need to do these two things first. That way you can build your wealth. The simplest way to do this is to create a financial system. One of the things you can do is to follow our 75, 15, 10 plan. What that means is for every dollar you earn here, so you make $1 from your paycheck or your business or however you make your money, every time you make a dollar, it's going to flow down in this way. Out of this dollar, 75 cents is the maximum you can spend, 15 cents is the minimum you should invest, and 10 cents is the minimum you should save. When you do this, now you're investing and saving your money and building your wealth first before you spend your money. Now, if you're younger and you don't have a ton of financial responsibilities, then this is your time to build. What you should be doing is following our 50, 30, 20 plan. That means now you're spending less money, you're only spending 50 cents out of every dollar you earn, but you're investing 30 cents and you're saving 20 cents because now this is your opportunity to build. If you don't have a ton of expenses, then invest and save more aggressively now. That way you can build the foundation for your financial wealth. This is where a lot of people put up a smokescreen. They say, oh, you shouldn't worry about money like that. Money doesn't matter. You should just work on being happy. And yeah, you need to be happy, but money is a tool, okay? If you are a good person, money will give you a tool to do more good. If you are a bad person, then money gives you a tool to do more bad. The size of your paycheck matters, but it's not going to determine whether you're going to become wealthy or not. It's what you do with the money you make. Because if you make $200,000 a year and now you're spending $200,000 or you're spending $220,000 with credit cards and loans, well, you're broke. But if you make $30,000 a year and you're saving 10% and you're saving 15%, you are setting yourself up for wealth. But now, in order to build that financial foundation, there's 5 other things that I need you to do. I'm going to be talking about these 5 things. First, you got to track your money. You got to know where every dollar you're earning is going. Then you need to build a financial shield to protect yourself. Then you gotta stop bleeding cash. Then you gotta put your money to work. That way your money can make you money. And then you gotta put fuel on the fire to amplify the system. That way you can build your wealth even faster. First, you gotta know where your money is going. Because if you don't know where your money is going, then it is going to disappear. So you need to track how much money you're making and where your money is going. How much money you're spending, where you're spending it, how much you're investing, and how much you're saving. You need to have a track of all of your money, and this is something that you need to do every month. Even if you're not a financial person, you don't like talking about money, this doesn't have to be too hard. There's a ton of free apps out there that you can use to help track your money and help monitor your money. I'm kind of old school. I just use an Excel sheet. I've kind of built my own pro forma and my own kind of system where in the beginning of every month, I write down on my Excel sheet how much money I made and where all my money went, because if you don't know where your money is going, it is going to disappear. In the business world, what we say is if you can't track it, you can't optimize it, because if you don't know how well the system's running, you can't improve that system. Well, it's the exact same with your money. If you don't know where all your money is going, you can't improve where your money is going. You can't improve your wealth because you have nowhere to see how your money is being spent. Once you start writing down where your money is going, the second thing you need to do is build a financial shield, because you need savings. Right now, the vast majority of Americans don't have $1,000 saved up, but the reality is sometimes life happens and emergencies happen and you need cash to cover that emergency, because if you don't have cash, then now you got to go into credit card debt, which is very expensive, or you got to get a payday loan, or you got to get a hard money loan. And in all of these situations, you are getting skinned alive by the lender, and I don't want you to do that, which is why you need to start saving some cash. That way you have a financial shield to protect you from emergencies. In general, your goal should be to save something like 3 to 6 months worth of expenses in your savings account. Now, this savings money is not money that you're going to use for a down payment on a house. It's not money that you're going to use to go buy a nice car. It's not money you're going to use to buy a new cell phone. This money is just sitting there to protect you from an emergency. That way you don't have to go into credit card debt when an emergency happens. So this should be your base goal, 3 to 6 months worth of savings. But if you really want to protect yourself and you want to be really risk adverse, then you should have something like 12 months worth of expenses saved. You don't really want to have too much more than that, because saving money is losing money. Your savings accounts are not paying that much in interest, yet at the same time, inflation is 2 or 3% a year. What that means is the price of things, the price of living is going up by 2 or 3% a year, while your savings are just sitting there flat. So if your savings aren't growing, but the price of everything else around you keeps going up by 2 or 3% a year, that means your savings are essentially losing value each and every day, which is why, yeah, you need savings to protect you. But you don't want to save all your cash because your goal should be to build your wealth, and I'm going to talk about that in just a second. If you're subscribed to our YouTube channel, you know that I love using my credit card to make transactions because anytime I use a credit card, I get cash back, I get points, and I never carry any interest because I pay off my entire credit card balance in full every single month. That way I get the perks and the rewards from the credit card company, and I don't pay them any additional money in interest. But a lot of people right now are getting skinned alive by the credit card companies because they're spending money on extra guac that they can't afford, and now you're having to pay 15, 16, 17, 18% interest on that extra guac, which is skinning you alive. And so what you need to do right now is stop bleeding cash. You know, it's always kind of funny to think about this because we talk a lot about investing on a YouTube channel, and I'll talk about, okay, if you get a 7% return on your money, this is what will happen, or if you get a 10% return on your money, this is what will happen. And every single time I do that, people will leave comments saying things like, or where am I supposed to get a consistent 10% return? But at the same time, do you want to know somebody who is getting a consistent 19% return every single year? Your credit card company. And you are the one paying it if you have credit card debt. Let me show you what I mean. So I was reading on a NerdWallet article that many Americans are taking more than 10 years to pay off their credit card debt. So if your credit card company is charging you 19% a year, what would happen if you invested that money and got a 19% return on your money? If you could invest $1,000 a month, and let's say you can get a 19% return on your money every single year. Now, I know it's not very easy to get a 19% return every single year, but your credit card company is doing it. So if you invest $1,000 a month and you can get a 19% return on your money every single year, and you do this for 10 years, which is what a lot of people are taking to pay off their credit card debt, this $1,000 a month investment would grow to over $420,000 over those 10 years if you could get the same 19% return on your money. Well, your credit card is getting that 19% return on your money, and so your credit card is becoming wealthy because of you while you are staying broke. So what you need to do right now is you need to stop bleeding cash because you need to pay off your credit card debt as fast as possible. Credit cards are a tool. If you know how to use them and you know how to use your money, you can get a bunch of free perks, you can get a bunch of cash back for doing nothing except making your regular transactions with a credit card. If you don't know how to use a credit card, then you are being skinned alive by a credit card company, and you need to stop bleeding cash and you need to get rid of your credit card until you can figure out how to control your spending. And right now, you need to get out of credit card debt as fast as possible. That means cut your expenses, work harder at your job, get a raise, do whatever you gotta do, find some extra cash and put it towards your credit card debt because you gotta stop bleeding cash as fast as possible because this is eating away at your wealth. Once you get here to number 4, this is where things get really fun because now you're putting money to work. You can only work 10, 12, 14, maybe 16 hours a day consistently. I mean, yeah, maybe some days you can work 20, 22 hours a day, but you can't do that consistently, okay? You're gonna get burned out. But your money doesn't need sleep. Your money doesn't need to go to the bathroom. Your money doesn't need a vacation. Your money can work for you 24 hours a day, 7 days a week, including holidays, which is why once you got this extra cash, you need to put it to work. That way your money can earn you more money because you need your money working for you while you're sleeping. This is what investing is all about. You're sending your money out, that way your money can attract you more money. Lots of people assume that putting your money to work and investing means that you have to throw your money in the stock market, but that's not the only way that you can invest your money, and it depends on what your risk tolerance is. One of the simplest and easiest and the least risky ways to invest your money is just by paying down your debt. If you have student loans that are costing you 6% a year in interest, and you pay it off a year early, well, now you just got a 6% guaranteed return on your money for that year, because now you don't have to pay 6% in interest to the bank or your lender. That 6% is what you get to keep in your pocket because you paid off your student loans a year earlier. This doesn't have really any risk because if you pay down your debt early, that's interest that you don't have to pay. You should also be investing in yourself and your own mind because like everybody says, you are your own best investment. If you know how to use your money better, you can use your money better and get a better return on your money. Now, this takes time and it takes money, but this can be one of the most valuable things that you do because if you don't know how to invest your money, then you're not going to to be able to get the best returns. So this could mean reading books, it could mean taking classes online, it could mean going to seminars, whatever it is. You need to be investing in your education, especially your financial education, if you want to know how to use your money the right way. That way you can get the best returns on your money. The other kind of education is financial tuition, and financial tuition is when you lose money by making a bad investment. I'm a real estate investor and I have read a ton of books on real estate investing, but some of the best real estate investing knowledge I got was by investing in a property, which I call my nightmare property, where I lost a ton of money. It was my education. It was the financial tuition I had to pay to learn how to be a good real estate investor, because there's just some things that you can't learn in books. There's just some things that you can't learn in courses. So that's another kind of education where you just go out and do things, because there will be times when you lose money. That's just reality. By the way, if you do want to learn more about my worst real estate deal ever, it was a nightmare property.
I read a lot of books that say, every real estate investor has one really bad deal. This is mine. So I want you guys to learn from my mistakes. This is not something to teach you in business books or even something to talk about in real estate books. So I want you guys to learn from my mistakes so you don't make the same mistakes as I did, because it was very expensive. Let's take a look inside.
I walked through that deal on YouTube, and if you want to watch that video, I will also link it for you in the description below. Then you have investing in assets. This is your more traditional type of investing, because now we're talking about investing in the stock market or investing in real estate. Now you're really just putting your money to work. That way your money can attract you more money. The way it works is now you're buying an asset, you're buying an investment for the purpose of making money, because you're buying something that you think will go up in value. So if you buy a stock for $100 a share, and then this company starts to make more money and the value of your stock goes to $200 a share, now you just doubled your money. You can also put your money to work for passive income, because now certain stocks pay dividends. What dividends are cash payments, is passive income that you get just for owning a stock that pays a dividend. It's the same with real estate. If you buy a home, you can rent out this home for $1,000 a month, and now every single month your tenants are going to pay you $1,000 a month for living in your property. And now even if you're sitting on a beach somewhere, you're still getting $1,000 a month every single month from your tenants that are living in your property, and you don't have to do any of the work because you put your money to work. You use your money to buy an asset, to buy this house, and now your money through this asset is generating you passive income. And the best part of all is now you're creating a new income stream that you're earning without having to physically go to work. Because now if you have income coming in from your stocks, or if you have income coming in from your real estate, this is money that you're getting without you going to your job. Now let me give you a quick disclaimer here, because there's a lot of kind of misconceptions out there about passive income and investing, with a lot of people on the internet saying, oh, you can become a millionaire overnight by just throwing your money in stocks or by throwing your money in real estate. Well, it doesn't really work like that. It is a slow, gradual wealth building process where the more money you put in, the better returns you will generally see, and the more time you have, the more money you will make. Now, before we get into number 5, I do want to let you know where you can learn more about investing, because our team puts out tons of articles on how to invest your money and build wealth through stocks and real estate on our website, theminoritymindset.com. And I'll also link an article for you up here and in the description below. And that's when we come to number 5, putting fuel on the fire, where now you understand how to use your money, and now it's time to earn more money because you know how to grow your money even bigger. The reason I talk about this now, not earlier, is because a lot of people think that the solution to their money problems is just earning more money. But there's a little problem with that. If you don't know how to manage your money with $40,000 a year, you're not going to know how to manage your money suddenly at $400,000 a year, or even $4 million a year. That's why 70% of lottery winners become broke or bankrupt within just 5 years of winning the lottery. And that's why 78% of NFL players who make a ton of money while they're playing in the NFL end up broke or bankrupt within just 2 years of retiring from the NFL. Making more money does you no good unless you know how to use your money first. That's why once you know how to use your money, it's all about putting fuel on the fire, because now you have a financial system. You've built your savings cushion. You're no longer bleeding cash, and now you're putting your money to work. Once you do that, it's all about amplifying the system by earning more money and putting fuel on the fire. The way you do this is going to depend on you. For some of you, that might mean asking for a raise or working to get a promotion, something where you can get more money from your job. For others of you, maybe you're working a job, but you also really like baking cakes. If that's the case, now you can start a side hustle where on the weekends, you're baking cakes and you're selling it to your friends and your neighbors and other people that like your cake. And for others of you, you might have an entrepreneurial bug where you just really want to start a business. The whole purpose here is now when you make more more money, you don't just go out and buy a fancy car. You follow your financial system. You're going 75, 15, 10, or you're going 50, 30, 20. Whenever you make more money, you're just taking that money and you're putting it into your funnel. That way you're investing more money, you're saving more money until you have the savings cushion built up, and then you're spending a little bit more money. The whole purpose of all of this is to manage your money in a way where you're paying yourself and you're building your wealth first before you go out and spend all your money and make all of those companies around you rich. Before we get into the next clip, if you are interested in learning more about how you can manage your money the right way, that way you can build wealth, have a financial system, and invest your money, our team put together an amazing guide that walks you through how to do this. You can download this guide for free when you sign up for our daily newsletter, and you can do that by clicking the link up here or by clicking the link in the description below. Americans are not saving enough money. Just 40% of Americans have the means to protect them from an emergency like a leaky roof or needing to replace their tires, which means 60% of Americans, the majority of America, does not have the cash necessary to protect them from a leaky roof or having to replace their car tires without going into credit card debt or having to go to the bank and having to borrow money. Now, there's a lot more to becoming wealthy than just living smaller and cutting back expenses and saving your money and being cheap. I actually just made a video on YouTube where I talked about if being cheap can make you rich. So if you want to learn more about that, I will link that video for you in the description below and also for you up here. But you got to know how to take that first step. That way you can build your financial base. That way you can have some cash in the bank. And you know what? It really doesn't have to be as burdensome as just never spending any money and never having any fun if you know how to save your money the right way, which is why in this video, I'm going to be going over 10 ways that you can save $1,000 quickly. But before we get into that, I need you to do me a quick favor and smash that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. And I'm gonna start by talking about why you need to review your bills. I'm a gym person. I love working out, and my gym membership costs me $70 a month to work out at my gym. But I noticed on my credit card statements that my gym membership wasn't charging me $70 a month, they were charging me $75 a month. And so I got kind of curious, what is this extra $5 for? So I called up the gym and they said that they signed me up for a magazine that I never knew that I signed up for, and that's why they were charging me an extra $5 a month. Now, I've had my gym membership for years, and I'll probably continue to have my gym membership for many years into the future, and they were just slapping on this $5 fee because they probably thought no one's gonna check their bills. Now, an extra $5 a month isn't really gonna change my life. I mean, maybe I guess I could afford another side of extra guac, but I'll get to that in a little bit. The whole idea here is you gotta figure out what you need and you gotta see what you're paying for. Chances are, if you pull out your credit card statement and you go through all of your bills, you're gonna find that you have subscription services that you do not need anymore, and you're gonna find that you're paying for things that you don't use. The simplest way that you can start saving some money is just stop paying for the things that you're not using anymore, because chances are you're paying for something that you're not even using. And when it comes to the things that you are using, like your gym membership, make sure you're only paying for what you use. Like if you got a gym membership, make sure you're only paying for the gym membership and not some magazine that you've never read in your life. Second, you gotta know the true cost of what you're buying. If you go to the mall and you buy yourself a nice $150 jacket, what is the true cost of your jacket? So many of you might be thinking at this point that if you bought a $150 jacket, the true cost is $150. But that's not the full story. Yeah, you paid $150, but I want you to really know what it cost you to get the $150. So let's say you make $20 an hour. So if you make $20 an hour, how long did it take you to make this $150? That would be what, 5, 6, 7, 7.5 hours of work to get this $150 jacket. But this is actually before taxes, because remember, Uncle Sam's got to take their cut with the IRS. So after taxes, it's actually going to cost you 9.5 hours of time to buy this jacket. Would you rather have the jacket, or would you rather have 9.5 hours of time? This is almost always one of the first calculations I have in my mind, because I always want to know, how much time is this thing gonna cost me that I want to buy? Now, I get it, you can have passive investments that pay you without you having to physically work, but you gotta know how much your time is worth, and if you know that, then you can calculate how much time this thing is gonna cost you, and then you can really ask yourself, do I want to spend this money on this jacket? So now you know that the true cost of your jacket isn't just $150, it's almost 10 hours of your time. But the second thing you need to ask yourself when it comes to the true cost is, what would this jacket be worth in the future if you didn't buy a jacket? Because what I want to know is, if I didn't buy this jacket and I invested this money, what would this money have become? because if I invested the $150, this $150 in 10 years would be worth not $150, but $300. And in 20 years, this money that I would have spent on my jacket wouldn't be $150. It would be about $600. And in 30 years, this $150 that I spent on my jacket would have become more than $1.1 thousand if I had just invested the money. So now, the real cost of this jacket isn't $150. It is almost 10 hours of my time, and it is the opportunity to make $1,100 over the next 30 years. Now you can ask yourself, do I really want to spend $150 on a jacket now? Too late, I already got it, Jasprit. One of the easiest ways to save money quickly is just to not spend our money. But the tough part about that is when we want something, we want it right now. And so what I want you to do is just take a step back before you go out and you buy that jacket on impulse, or before you go and you buy something that you don't need. Just take a step back and ask yourself, what is the true cost? How much time would it cost you to actually get that? And how much money is this going to cost you over the long run? Once you do that, I want you to follow the 24-hour rule, which says you want to buy something, great. Now just take a step back, wait 24 hours, and then decide if you really want to buy it. If you still want to buy it and you do these calculations, then go out and buy it. But if after those 24 hours, you thought about how much time it's going to cost you, and you thought of how much money you're losing out of in the future, and now you decided not to buy it, well, now you just save some cash by not spending it. Third, let's talk about eating out and drinking out, because there's a huge debate in the financial world about coffee. You have people like Susie Orman who say that you going out and drinking Starbucks is one of the dumbest things that you can do with your money. And then you have people like Ramit Sethi who say the opposite. He says that it doesn't matter if you spend $5 at Starbucks because $5 is just $5. It's not going to make a difference. And then you have people like Graham Stephan who popularized the 20-cent coffee because he makes his coffee at home. Now, honestly, I can't relate to any of that because I don't like coffee. Coffee tastes like poo-poo. I don't drink coffee. I drink tea. If you go out to Costco and you buy their big pack of green tea, it's gonna cost you something like 24 cents to drink one glass of tea. Now, personally, I'm a big fan of nice teas because there's a difference between your kind of lower quality teas and your nicer teas. If you want a nice cup of tea, it is going to cost you somewhere between 35 cents to 50 cents if you make it at home. If you go out and you buy the same tea from a nice tea shop, it is going to cost you at a very minimum of $3.50. So clearly, if you went out and you made your tea yourself, you're going to save $3 every time you make your tea at home. But let's also talk about the food. If you're subscribed to our YouTube channel, you know that I love food, and more specifically, you know that I love guac. Now, if I go out and I go to Target and I buy an avocado right now, it is going to cost me something like 89 cents. Okay, if I go out and I buy this avocado, so I'm gonna draw you an avocado that looks more like a cookie than an avocado, but if I paid 89 cents for this avocado, I can make 4 sides of guac. Okay, now if you're like me and you really like guac, maybe this is just gonna make you one side, one avocado, one side, but let's assume that you can make 4 sides of guac from this one avocado. That means if you eat your guac at home, you are gonna be paying somewhere between 25 cents, I'm gonna round up here, to 89 cents for your side of guac. 89 cents if you're someone like me who wants to eat the whole avocado, 25 cents if you only wanna eat a fourth of that. Okay, you're gonna be paying less than $1 if you wanna get your guac, but if you go to the store, if you go to a restaurant and you wanna get a side of guac, it is gonna cost you at least $3 for a small side of guac, and you're barely gonna get a quarter's worth of guacamole. If you just make your nice tea at home, and I don't know about coffee, but tea is very easy to make at home. All you gotta do is warm up some water and put some tea leaves in there or put a tea packet in there. It is very easy. You don't need any fancy equipment. So if you just make your tea at home and you eat your avocado at home, you're gonna save $6 between the two. Now, if you do this 5 times a week, like many people do, 52 weeks a year, you are going to save $1,500 $100 over the course of a year just by eating your avocados at home and just by making your tea at home. This is where I want to give you a little disclaimer because you know what? I like tea and sometimes I do like drinking in a tea shop. I'm not one of those people who says I never go out to the tea shop and drink tea. I like to have a lot of meetings over tea. I don't go to the bar, I don't drink, I don't do things like that, but I do like tea. And I have a lot of meetings over tea. So sometimes for the experience, I will go out and I will drink this tea. But when it comes to my daily tea, I don't drink tea every single day, but when it comes to my regular general tea, then I'm just gonna make it at home and I'm not going to the tea shop every morning to get my morning tea. This is where I want you to draw a line between consumption and enjoyment. If you're just going to the tea shop every morning to drink your tea and you're just putting extra guac in your lunch because you like guacamole, you are blowing money on things that you don't need. But if you're going out to hang out with your friends because you want to drink some tea together and have a good time, sure, go out and pay $3.50 for a tea. That's okay. But spending this money every single morning just because you don't want to brew it at home, that's a different story. It is okay to go out and have a cup of tea with your friends or go out to a restaurant once in a while, but it is different when you're talking about doing it every single day just because that's what you think is normal, because you want to go out and you want to eat a burrito and you want to get extra guac every single day. By the way, if you are eating in restaurants, just drink water. You are going to save a ton of money just by drinking water instead of ordering a Coke. One thing that I learned growing up in the Indian household is that everything is negotiable. If you're in India and you go out and you buy yourself some apples, you're going to negotiate the price of that. If you go out and you buy yourself a new shirt, you're going to negotiate the price of that. Okay? Almost everything is negotiable if you ask. Worst case, they just tell you no. One of the simplest and least painful ways to spend less money every single month is just to negotiate your bills lower. So what I want you to do is start by taking all of your utility bills. So your cable bill, your internet bill, your phone bills. Take these bills and now look at what your competitors are charging. Chances are that the competitors to the companies you have some lower introductory rates out there right now. Now what I want you to do is try to get the bill that you're paying right now down to your competitors' lower introductory rates. That way you're getting the same service at a lower price, so you're literally just saving money for doing nothing except making a 15-minute phone call. The way you do that is you're gonna call up the customer service number on your statement and you're gonna say, "Hi, I was wondering if there's anything you could do about my bill because I feel like it's really high." Now, they're going to say either yes, we can bring it down a little bit, or they're going to say no, there's nothing we can do. No matter what they say, even if they agree to lower your bill, I want you to push them lower. What you're going to say is, "Oh, really? Okay, I saw that your competitor so-and-so was charging only $25 a month. Is there any way you can match or beat that? I'd really like to stay with your company." Now what you just did is you subtly put it in their head that you are considering leaving because their competitor is charging a lower fee. No company wants to lose a good paying customer to their competitor, especially if you've been there for a long time. So now what they're going to do is they're going to seriously see if they can bring your bill lower. If they don't bring your bill lower or they don't bring it low enough, that's when you want to ask to speak with the manager, because managers typically have more negotiating room. The key here for any of this to work is you need to be nice, because customer service agents are getting yelled at all day long by people complaining about their bills. If you are nice to them, they will be nice to you. This should go for any big purchase you want to make. Your home, even if you're leasing your home, you can negotiate the price of your lease. Your car, anytime you make a big purchase, make sure you negotiate it first. Fifth, I want you to move your savings. And that means two different things. As soon as you get paid, I want you to automatically move some money from your checking account, where your money goes into, to a savings account. That way you can't accidentally spend the money, because sometimes we feel that if we have cash in the bank, we should spend it. Well, if that money automatically leaves before you can touch it, now you're not going to have the urge to spend it because you're not going to see that money. So anytime you get paid, you need to automatically move some of your money to a savings account. That way you can't accidentally spend it on a new TV. Second, I want you to consider moving your savings account to an online bank that pays you a higher interest rate than a traditional bank, because if your money is saved at a traditional bank, chances are they're paying you next to nothing. If you move your money to an online bank, you should be able to get a much better return because online banks have lower fees. They don't have the same overhead and all the rent costs because they don't have those retail banks everywhere. So because they have lower fees, they can pay you a higher interest. Now, this higher interest is not going to substitute an investment and it's not going to make you rich. But if you're saving your money anyways, you might as well get a better return on your savings. That's what I do with my savings. I know that my savings are not doing anything except sitting there collecting dust, so I move my savings to an online bank. That way I can at least get some interest and get some money for my savings because it's just sitting there doing nothing anyways. And if you do want to learn more about how you can save your money and get a better return at an online bank, our team has written an article on this on our website, theminority-mindset.com, and I'll also link this article for you up here and in the description below. Sixth, I need you to start shopping around for the right things, because when I say shop around, I don't mean shopping around for a new Gucci scarf. I mean shopping around for the services that you can save some money on. Your insurance, so this is your health insurance, your home insurance, your car insurance, all the different insurances that you have, your phone bill, your cable bill, and your internet bill. I need you to shop around for these 4 things every single year, because chances are these companies are going to raise your bill every single year, and so you want to make sure you're getting the best rate, because if you just stick with one company because you don't want to shop around, you are going to get ripped off. So every year I want you to spend just half an hour shopping around. That way you can make sure you're getting the best deal possible. You can even negotiate the price of your bill lower like I just talked about, but you want to make sure that you're not overpaying, because this is a simple way to save a ton of money. Seventh, we all have things that are sitting there in a house that aren't doing anything. Like when I graduated law school, I had a ton of books in my room that were just taking up space and collecting dust. So I went out and I sold a bunch of my textbooks, and I made like $400 just selling the textbooks that were doing nothing except taking up space. We all have things in our homes that we're not using that are just taking up space and collecting dust. What I want you to do is take the things that you do not need and take them and sell them. Your kids' clothes, your old furniture, your old phone, your old TV, your old electronics, all these things have some value, and you can go out and you can turn these old things that are collecting dust into some cash if you just spend the time to go out and sell them. 8, pay your stuff on time. So this is one of my pet peeves. I cannot stand paying late fees, because when you pay for a late fee, you are paying for something that you're getting no value for. Like when you pay a $25 late fee, you are getting no extra value. You just forgot to pay the bill. And Americans on average are paying $250 a year in late fees alone. That's $250 that you're spending on something that's giving you no value and no return. If you just want to throw your money in the garbage, you might as well just mail it to me. Avoid paying late fees at all costs. Put it in your calendar, use auto pay, set reminders, do whatever you gotta do. That way you don't have to pay a $25 late fee. 9, you can use technology to help you save money automatically. There are apps out there like Honey and Piggy. I like to use Honey. And literally, as you're checking out, if you buy something online, Honey will come up and it'll tell you, oh, do you want to save $20 on your order just by using this coupon code? Yes. And so now you just save $20 by doing nothing except having this free extension that helps find you coupon codes to help you save money on purchases online. It's the same with using a loyalty program or a cashback program, where now you're just saving money by doing nothing except just using one of these free programs that are going to save you money because you use the free program. And lastly, if you want to save $1,000 quickly, what I want you to do is next time you buy something, I want you to ask yourself, would you rather have that sweater you want to buy or whatever it is you're buying, or would you rather have cash in your hand? If you'd rather make $150 or have $150 instead of having a sweater, well then you can just not buy the sweater and keep $150, because now this is $150 that you get to keep in your pocket because you just didn't spend this money on the sweater now. You got to keep the cash and you don't get the sweater, but at least you got some cash. By the way, in case you were wondering, I did not pay $150 for the sweater. I think I paid like $9 or $10 for the sweater because I bought it online on clearance. You've probably heard people say things like the Fed is printing money out of thin air and the United States is borrowing money like crazy and the value of our dollars are being diluted. Today, I want to go a little bit deeper and talk about how money is created, not just from the Fed's perspective, but how you can create money too. Yes, it is possible. This is what every wealthy person knows and understands, and if you do not understand how to create money or wealth, then you're never going to be able to take advantage of it. To understand how you can create money, we need to first understand how the Fed creates money, which I'm going to talk about in just a second. But before I do that, I need you to do me a quick favor and smash that thumbs up button below. In the United States, your money, your dollars are created through debt, and you'll see exactly what I mean. So let's say you have $100 in your pocket, and I'm gonna draw you a nice mustache, and you deposit this $100 into your bank savings account. And then George, Nancy, and Bunty all do the same thing. They all deposit $100 into the bank. So now the bank has $400 in savings or deposits in their accounts. The bank is going to want to make some money off of this $400. They're not just going to keep it in a vault sitting there collecting dust. So what they're going to do is they're going to invest this $400, and the bank is in the business of lending money. So now Bunty, who was over here, I put him over here now, Bunty wants to buy a car, and he wants to go to the bank and get a $300 loan. So we're going to assume that cars only cost $300 in this world. So the bank loans Bunty $300. The bank has the money to do that because they have $400, and now Bunty is going to pay the bank back 5% interest or so. So Bunty is going to pay the bank back in interest over the next 5 years, but the bank now doesn't have $400 sitting in their vault. They only have $100 because they just paid out $300 in loans, and they're not going to get this $300 back until Bunty pays off this entire loan. Now what the bank is going to do is they're going to pay all of you depositors back a teeny tiny bit of interest because the bank is using your savings to loan it out as an investment. Your interest is not going to be that much, but that's what the bank gives you in order to lend your money out. Now this situation that I'm showing you right now is not an ideal situation for the bank, because the bank is going to run out of money very quickly. You have deposited, all of you depositors, $400 into the bank. Bunty took out $300 for a loan, and now the bank is going to run out of money very quickly. If Nancy and George went to the bank to withdraw their cash because they deposited $100 into the bank is going to say, oh, sorry, we don't have the money to give you your money back. You're going to have to wait 5 years for Bunty to repay back all of his loans. If that happened, you would see mass panic and mass chaos. So that's why the system doesn't work like this. Instead, here's what happens. So let me clean this up really quickly. That way you can see what happens. Now, you, Nancy, George, and Bunty all deposit $100 in the bank. So now the bank has $400, but the government says, okay, bank, you are not allowed to lend out all $400 that you have. You have to keep some money in reserves. So typically it's 10% in reserves. So if the bank received $400, that means they're only allowed to have $360 to lend out of these deposits, and they have to keep $40 in reserves just in case. So if people want to go get their money back and the bank doesn't always have some cash, they have this money in reserves. That way they are protected by having a little bit of a safety net, and then they use something called the fractional reserve banking system to help them lend out even more money. If this was the only money the banks could lend out, then banks would be very limited as to how many loans they could make, because if they made 1 or 2 loans and people started pulling their money out, your bank would run out of money. And so this fractional reserve banking system was created to help banks lend out even more money by lending out money they don't have. To make this fractional reserve banking system work, the bank will now go to the Federal Reserve Bank, and they're going to say, hey Fed, what can we do to lend out more money? And the Fed is going to say, okay, show me how much money you have in deposits. $360? Okay, we will give you 20x your deposits. That way you have more money to loan out. So in this situation, the Fed would give the bank something like $7,000. This way the bank has more money to lend out. But the issue here is the Federal Reserve Bank isn't a bank. Like, you can't go there to deposit money. They are not a reserve because they don't keep any cash reserves, and they're not federal. They even say so on their website. So if the Fed wants to create the $7,000 so your bank has more money to lend out, the Fed has to create this money literally out of thin air. That way your bank has more money to lend out, and the way that your bank puts this money back into circulation is not by giving this money to people, it's by lending this money out. This is why your money is debt, because your money is created out of thin air and then it's lent out into the economy. That's how it's put into our circulation. Every time another loan is issued by your bank, the Fed issues more money, creates this money out of thin air, and gives it to your bank. That way your bank has more money to lend out, and that way your bank has more money. That way, in case somebody went to go withdraw their cash, the bank has this cash. But this money creation process and this fractional reserve banking process gets even more interesting if you look at how it evolves. Let's go back to the original example. You, Bunty, George, Nancy all deposit $100 into the bank. The bank has $400. They have to put 10% in reserves, $40. They have $360 in lendable deposits. They go to the Fed gives them another $7,000, and then Bunty wants to borrow $300. That way he can go and buy a car. So now Bunty's going to take this fresh new $300 that he just got from the bank that the Fed just printed, and now Bunty's going to take this $300 and he is going to give it to his car company, and in exchange, the car company is going to give him, I'll put this in black, the car company is going to give Bunty a car, and now this car company has $300, and what are they going to do with that $300? The car company is going to take the $300 and they are going to deposit it into their bank. Now Bank 2 just got a fresh new $300 deposit, and they got to follow the rules. They're going to put aside 10% or $30 in reserves, and then they're going to have $270 in lendable deposits. But now they're going to follow the same fractional reserve banking system, and Bank 2 is now going to go to the Fed, and they're going to say, hey Fed, can you give us some more money so we have more money to lend out? And now the Fed is going to give Bank 2 about $5,000, right? 20x deposits. And now Bank 2 has more money that was just created out of thin air because this money was created as debt. It was given to Bunty. Bunty went and bought this car. This car company put it into their bank, and now more money was created. And now Bank 2 will have more money, more debt that was created that they can lend out. As you can see, this creates one big cycle of debt. More money is borrowed, so more money is created, which means more money is going to be borrowed, which means more money is going to be created. And now we have this whole system of fractional reserve spending and fractional reserve lending and fractional reserve banking, and everybody is living off of this money, which is actually just debt. That's why they say the economy runs on spending, because if money is not being spent, then this whole system fails. So this system is how it works in a normal economy, but things are a little bit different in 2020 because we're in a recession. So remember what I just said. This system, our economy, runs on spending. When you're in a recession, spending slows down. And to encourage people to spend, the Federal Reserve Bank creates these regulations and rules and different programs to encourage people to spend. And if you look at the system, what's the best way to encourage people to spend? Make it easier for banks to loan out more money. So on March 26, 2020, the Federal Reserve Bank actually removed this 10% reserve requirement, which says that the banks no longer are required to keep any money in reserves. That means banks can lend out all $400 here, all $300 here. They don't have to keep any extra cash in reserves as a way for banks to have more money to lend out and to encourage them to make more loans. I mean, when has a safety net of cash ever come in handy anyways? Take a good look at this, because I'm about to clean this off and show you why this is so important to understand. If you've ever taken an accounting class before, you've heard the term assets and liabilities. Assets are things that put money into your pocket. Liabilities are things that take money away from your pocket. So when you go to the bank and you deposit $100 into your account, this is a liability for the bank, because this is $100 that the bank owes you, right? If you take $100 and you deposit into your savings account, that's not the bank's money, that's your money. So that's money that the bank owes you. But when the bank then loans this $100 out to somebody else, this $100 actually gets pushed onto the bank's asset side of their financial statements, because now they have just lent that money to somebody else, and now that's money that somebody else owes the bank. Plus, because of this fractional reserve banking system, they actually get to add another $900 or so, whatever how much money they lend out, and now they have $1,000 in assets on their financial statements because of a $100 liability. You deposited $100 in your account. This is a liability for the bank because this is money that your bank owes you. But then your bank turns around and they take your $100 and they lend it out to somebody else. So they turn this $100 liability into an asset, even though they still owe you this money, because now somebody else owes this money to the bank. The bank doesn't have your $100 anymore. They gave it away to somebody else, and then they multiplied it to $1,000. So they have just created these assets out of thin air. The exact same dollar that's a liability for the bank also turns out to be an asset for the bank times 10, just because of how money is created. To put this in perspective, your clothes are liabilities, right? They take money away from you. If you go to the mall and you spend $100 on clothes and you had the same system, That would mean that you spend $100 on clothes, which is a liability, and every time you spent $100 on clothes, somebody would magically come and just give you $1,000. Now, I want to talk about how you can use this system to benefit you. That way you can create money or wealth. But before I get into that, if you are interested in learning more about assets and liabilities and money management and investing, we have a free ebook on money management and investing that you can read for free when you sign up for our financial education emails, which are also free. If you want to read our free ebook and get our financial education emails, you can do that for free by clicking the link up here or by clicking the link in the description below. By the way, our financial education emails are separate from our financial news emails. The first way money is created is through debt. That's how money enters our economic system and our financial circulation. But the second way money can be created and how you can capitalize on it is through equity. Debt creates money and it puts it into the economic system. Equity then pulls this new money that was just created and it puts it into the pockets of people who understand money. The simplest way for you to understand this is to think about buying a home. Let's say you bought this home right here for $500,000. And then 10 years go by and now this home is now worth $500,000. It goes up in value. So now your home is worth, finish the windows, $1 million. You are now a millionaire because you have equity in your home worth $1 million, assuming you have no debt. You also just created this $500,000 of money or wealth right out of thin air. You didn't do anything to help your home increase in value. Maybe you did some renovations here or there, but that's not why your home is now worth $1 million. This $500,000 of equity was just created. What happened? Money was created through debt. And this debt went into the hands of people, and people took this money and they started buying homes in your area and your neighborhood. Now, when that happened, home values started to go up, and some of this new debt was now absorbed into the equity or value of your home. More money was created through debt, and you own this asset, and your equity in this asset went up because of this new creation of debt and money. At this point, you might not feel like a millionaire. You're still going to work every day and getting a paycheck and paying bills like normal, but you are a millionaire because you have equity of $1 million. Here's where people get in trouble. You are a millionaire on paper, okay? You don't have $1 million in your bank account and you don't have $1 million of income. You just have $1 million on paper, which says this is what your net worth is because this is what your home is, but you don't actually have this $1 million until you sell your property. And so where people get in trouble is now they take a refinance or they take a loan out on their assets, this equity, this property, and they start living this $1 million lifestyle. They buy all these liabilities. Remember, things that take money away from you. They start buying shoes and vacations, and now you're living this $1 million lifestyle. And then if the value of your property goes down, you are spending a $1 million lifestyle, but you are no longer a millionaire because your paper value just went down. It's not just homes. You can create this type of equity or wealth by buying an asset or something that creates more value. Let's talk about Amazon, the company, for a second. In the end of 2019, the Amazon stock was selling for something like $1,700 a share. So if you bought one share of Amazon, you would have had to pay $1,700 a share for that. In 2020, mid-2020, the Amazon stock was trading for above $3,000 a share. So now, if I finish drawing this is $1,300 additional. Now, for every $1,700 you paid into Amazon in 2020, you would have gotten another $1,300 of equity. Technically, this is called your appreciation, but you don't have to do anything to increase the value of your investment. You're not the one sitting there growing Amazon. I mean, maybe you're spending money on Amazon.com, but you don't have to physically do something to help increase the value of your investment. What happened, again, was money was created through debt, and this debt went into the hands of people, and people took their new money that was freshly created and they spent it at places like Amazon, and that made their company more valuable, and that made your equity, your stock, more valuable. You're benefiting from this new creation of money, which was debt, because it's creating you new money through the form of debt and equity. So money is created through the form of debt and it enters our financial circulation. Now, you can benefit from this by owning assets that are now pulling up this new debt or money that's created in the form of equity, because this makes the value of your investments more. This is what wealthy people do. They buy assets with equity, and then if this asset is creating more value, then the value of their investment creates more wealth. This is what financial education is all about. And if you're looking for more resources to learn how to do this, we have tons of videos on our channel, and we have a free ebook on financial education emails for you in the description below. The whole idea behind compound interest is you're going to invest some money today, this money is going to grow, and now you have your money working hard to make you money, and the money that your money made working hard to make you money. So it's almost like your money is having babies, and your money is just going to keep compounding and growing, which means you have more money working hard to make you money. Even if you're not investing your money in the traditional sense, you should hopefully still be earning this type of compound interest, because if you go to work every single day, you're compounding your knowledge and your skills. And so the longer you go to work, the more skills you're going to learn, and the more valuable you're going to be as an employee. That's why as you get older, your pay should hopefully go up too, because you're compounding your knowledge, you're compounding your skills, and now you're more valuable, which means you should be getting paid more money. It's the same concept with your money, except more money doesn't give you more skills, it just gives you more power. Like this $100 bill doesn't have more skills than this $20 bill does, it just has more power, because assuming that $1 will buy me a machine that's gonna make me a nickel, now with this $100 bill, I can buy 100 of those machines. With this $20 bill, I can only buy 20 of those machines. So I'm going to be able to earn more nickels with this $100 bill than this, just because I got more power with this piece of paper than this one. But this is where compounding becomes so powerful, because every dollar I earn will buy me another machine that makes me a nickel, and I need 20 nickels to earn a dollar. This $20 bill will get me 20 nickels, which will buy me one more nickel making machine. This $100 bill will earn me 100 nickels, which will buy me 5 more nickel making machines. So I'll be able to earn more nickels with this just because I got more buying power. The more dollars you have, the more dollars your money is going to be able to make, and the longer you let your money sit there and invest and compound, the more your money is going to be able to grow. That's why Albert Einstein calls compound interest the 8th wonder of the world, because now your money is working hard to earn you more money, and every time your money does that, you're going to have more money that you can send out to work hard and earn you more money. So it becomes a system, almost like this machine that's just working to produce you more money, and anytime you produce more money, you can buy another machine that's going to be working to produce you more money. You don't need a ton of money to start, but the longer you have, the more your money is going to be able to grow, which is why you're going to see the biggest returns towards the end of your compounding. Like even if you start with just 1 penny and you can double your money every single day, day 1 you have just a penny, and day 8 you have $1. By day 21, you have $10,000. Now your money is really starting to grow. And by day 30, you're gonna have over $5 million, and you started with just a penny. Now, I already know what you're thinking. But Jaspreet, if it was so easy for me to double a penny, I'd already be doing that right now. Now, I know it's not easy to double your money every single day, and that's not the goal, but you can do this over time. There's a couple different strategies that you can follow to compound your money and really build your wealth over time. There's an active strategy and a passive way. I'm gonna be going over this, but before I do, I need you to do me a quick favor and compound that thumbs up button below. Actively compounding your money is literally what the word says it is. You are being active and you are buying something, selling it, and now you're using your profits to go buy something else. You see this all the time in real estate. You go out and you buy a $100,000 property, you renovate it, whatever, you fix it up, and you go sell this property for $150,000. Now instead of going and buying another $100,000 property, you go out and you buy a $150,000 property and you renovate it, and now you sell it for $225,000. And so slowly you are growing your money and compounding your money because you can do bigger deals. Now you can do 2 deals at one time. You can do $200,000 deals and hopefully sell both of these for $150,000 each, and now you're just compounding what you're doing. You're slowly growing what you can do because you make some money and you take your profits and you reinvest it into whatever it is you're doing. This is exactly what I do on YouTube. Anytime somebody watches our videos on YouTube, I get paid. Thank you for your penny. Now, when I get this YouTube money, I can take all of it and go out and buy myself some new exotic cars, go get myself a new Gucci wardrobe, and go enjoy some fine dining at Chipotle with some extra guac. But what I actually do with this money is I reinvest this money back into our business. That way we can grow our business bigger. I'm reinvesting it back into our blog, I'm reinvesting it back into our newsletter, and I'm reinvesting it into an app that we're making. I'm actively working to compound this money by sacrificing some of these luxuries today that I could buy by reinvesting this money back into the business. That way I can grow the whole pie bigger. When I was in college, I started a cell phone accessory business with a friend of mine, and we didn't have a ton of money, and we wanted to start selling these like cell phone battery packs, and at the time we only bought like 10 of them because that's all we could afford. And so we bought 10 of these battery packs and we sold them, and then we took this money that we got and our profits and we went out and I think we bought 20 battery packs, and then we bought 50, and then we bought 100. And so it was like a slow compound where we took whatever money we had to buy these battery packs, we sold them, then we took this money and our profits and we compounded it, and that way we were able to buy more, sell more, buy more, sell more. And so you don't get to enjoy the profits when you're compounding it like this, because if you're taking all of your profits and reinvesting it, you're actively compounding it to grow the whole thing bigger. When you do this, the hope and the whole idea is you're gonna start off with something small, $100 or $1,000, and you're gonna grow it to something a little bit bigger. You're gonna turn $1,000 into $2,000. Now you're gonna reinvest the $2,000, turn it into $4,000, then the 4 to 8, the 8 to 16, and you're gonna slowly keep growing it. There is a risk though, because if you keep growing it and you don't take out any money for yourself, eventually there's a chance that things don't work out. And now you grew your $1,000 into $100,000 or $1 million, and then things fail. And if you didn't take out any money for yourself, now you're left with nothing. So if you're doing this type of active compounding, you really just gotta find the right risk balance for you, because anytime you pull a dollar out, that's a dollar that you cannot compound. But if you keep the dollars in there, then you take on more risk. I mean, this is one of the things that made Elon Musk so financially successful, because in the early stages of his career, when he would make $25 million, he would reinvest all of this money back into his business, and he would leave nothing for himself, because he wanted to compound and grow his dreams and his wealth by taking every dollar he had and throwing it back into his beliefs. The second way you can compound your money is the passive way, and this is what a lot of people think about when they think of compound investing, because now what you're doing is you were taking your money and you're putting it into an investment. You're gonna let your money grow, and anytime your money makes money, you are gonna reinvest that money back into it. That way this money that you have growing is gonna keep growing even if you don't add money into the pot, because your money is growing and this new money is gonna be working to make you money too. When I was in high school, anytime we talked about compounding or investing your money in my math class, the example that my teacher always gave me was investing your money in a CD in the bank or a savings account. So the way it works is you put your money in the bank, either in a CD or a bank account, and then your money is going to grow. And as your money sits there, it will compound and grow, because now this money that your money made will grow even more. But the interesting thing about this, so if we write bank account, you're not going to get a very good return, especially nowadays. A savings account nowadays is going to pay you like 0.1% if you're lucky, and a CD is going to pay you 1% if you're lucky. So if we look at this where you get a 1% return on your money, and I'm being very generous here, it is going to take you a long time for you to double your money. At this rate, keeping your money in the bank is going to take you 72 years to double your money. So you're not building wealth in this lifetime. Maybe your great grandkids will have some decent money to play with. If you're really looking to compound your money and grow your money, then you need to be putting your money in assets. So this would be things like the stock market. If you're investing in your money in the stock market, the goal is to grow your money by investing in companies that you believe in, because over time these companies are going to make more money, which will make the stock price more valuable for you. Now, if I come back here to active, if you do a business or flipping like we talked about, there's really no limit or kind of a baseline to how fast you can grow your money here. I mean, it's not super unreasonable to see 100% growth in a year, so it's really kind of uncertain as to how good of returns you'll see. It just depends on what it is you're doing and how good you are at it. So, there's really no baseline here. The stock market, on the other hand, has gone up by between 8 to 10% a year historically. So even if we stay on the low end here, 8%, you're going to be able to grow your money much faster. And the thing you got to understand about the stock market is there's a couple different ways that you can make money. You can make money through appreciation, which is when the price of your stock goes up, and you can also make money through dividends, which is when the company that you invest in literally just gives you a cash check. So if you can grow your money by 8% a year in the stock market, you can double your money every 9 years. That's a whole lot better than 72. Now, if we kind of really look at compounding your money, this is where a lot of people assume that you have to invest in dividend-paying companies, which are companies that pay you cash payments. That way you can compound your money, because in that case, when you get this dividend, then you could reinvest this dividend back into the stock market and buy more shares. That way now your money is actually growing. So you invest in a dividend-paying company, this company gives you some cash, then your money automatically gets invested. That way you can own more shares, and now as you own more shares, you're going to get more dividends. As you get more dividends, you can buy more shares. So it creates this reoccurring cycle of growth and compounding. This dividend reinvestment strategy is a great way for you to build your own wealth, because now anytime you get paid, you're going to automatically reinvest this money. If you want to learn more about how to do that, our team broke this down in an amazing article on our website where it shows you, one, how to do this reinvestment, how to invest in companies, and how to find a good brokerage that does this. So if you want to learn more about how to do that, I'll link the article for you in the description below. But what I also want you to understand is that not every company pays a dividend. The only companies that really pay dividends are really more established and more mature companies, because these are companies that at the end of the year, they have so much cash in their bank account, they have no better use for their money, because if they could reinvest this money back into their company and grow their company bigger, then they would probably do that. But they have so much cash where they're just like, you know what, let's just start giving it away to our shareholders, because we have no better use for this cash. And so people assume that the only way to compound their money is to invest in dividend-paying companies because these are companies that are giving you cash, and when you get this cash, you can reinvest it. But you can also compound your money by investing in companies on the stock market that are reinvesting their profits. If you find more of a startup company that you really like and you really believe in and you think is a good value, and you invest in this company, and this company, anytime they make money, they don't give it away in dividends. They take this extra cash and they reinvest it back into their company, so they're really not making that big of profits. Like how Amazon during the early years of it being public never made any money, because anytime it made money, it reinvested it back into the company. If you invest in a company like this, then your money is still compounding because you own shares of a company that's using all of its money to grow itself. And so while you're not getting this cash payment and accumulating more shares, your shares become more valuable because of this compounding, because the company that you're investing in is compounding all their money because they're taking all of their profits and reinvesting it. And there are pros and cons to both, because this type of investing, where you invest in more of a startup type company, has more risk because there's a chance that this company will fail, like we talked about here. If you're actively compounding your money, which is what this company is doing, there's a chance that it could fail. And so yeah, they're reinvesting all their profits and they're doing everything they can. But if this strategy fails, then there goes your investment. But on the flip side, with these dividend investments, because these dividend paying companies are typically larger and more mature, you're going to have a safer investment, which usually comes with a smaller return. So you might not see the stock price go up as fast, and your average dividend is typically somewhere in the 2 to 4% range. It really depends on the company, so it's not anything huge, and hopefully it will go up over time, but you just got to kind of understand where you want to be. It comes with lower returns here, higher potential returns here, but more risk. The second thing is with dividends, anytime you get paid a dividend, you have to pay taxes on this dividend. So while you take this dividend and you reinvest it, you still have to pay taxes on the money that you made, even though you don't actually get that money in your bank account, because you're, in this case, reinvesting that money. Another way that you can compound your money is by investing your money in real estate. This is my actually favorite place to invest my money, because not only do you get passive income, if you do it right, you will also get the appreciation in the property. And so with real estate, when I invest my money, I'm looking for a 7% annual return on my money, cash on cash minimum. Ideally something closer to 8%, but 7% is my real minimum. Now the thing that you got to understand here is that if I get a 7% return on my money, it's going to take me 10 years to double my money. But in this case, the 7% is a cash on cash return that I'm getting every single year in my pocket. So if I buy a $100,000 property, that means every year I'm making at least $7,000 in profit. Hopefully over time this is going to go up if rent prices go up, but that means I'm making $7,000 a year. And now what I can do is, after 10 years, I will have this cash in the bank that I can use to go out and buy another property, or I can just take my own cash, go out and buy another property and supplement it with this money that I'm making from real estate. The reason that real estate becomes so attractive now on top of this is because not only are you getting this cash flow, but if you're buying your properties in a good area where people want to live, then you're also going to see the property value go up too. So I buy this $100,000 property, and every year I'm getting $7,000 a year in passive income, but over time this property might go up in value to, let's say, $200,000. And now if it comes time for me to sell this property, I sell it for $200,000, I can do something called a 1031 exchange. It's a little loophole in the real estate world where now I can take all $200,000, pay $0 in taxes, and go out and buy a $200,000 property that's going to pay me with more passive income. And so when I tried to do that in the stock market with dividends, the first thing I had to do was pay taxes on my dividends, and then I could reinvest these dividends. With real estate, if the property value goes up, now I can sell the property, pay no taxes today on those profits, and go out and buy myself a bigger property that's going to pay me with more money. Plus, even on the passive income, the cash flow that I'm making from real estate, this money that I'm getting here, there's a lot of tax breaks that I get with real estate that I don't get with the stock market. So even as I get the $7,000 a year in passive income, I don't have to pay taxes on all $7,000 because there's other tax deductions that I can take, like something called the depreciation tax deduction, which says that I get to get a deduction because my property is 1 year older. So happy birthday to your property, you get a tax break. So from a tax perspective, you get more benefits here from real estate, but real estate does come with its own downfalls because now you have to deal with more people. Like when you're investing in stocks, you're not dealing with anybody. You can go out and buy shares of Amazon or Lululemon or Chipotle and McDonald's and not have to deal with a single person. You can do this right off your phone. You want to go out and buy a real estate property, you got to have a real estate agent, you got to have a property manager, you got to deal with a contractor, you got to deal with an attorney, and you got to deal with tenants. And so if you don't want to be in that game, the stock market is better for you. Plus with real estate, you're in charge. You're the one that actually has to make sure that your property is generating income, and it's more work on your end because now you got to be the one that's negotiating the deal. And if your tenant doesn't pay or if your tenant damages the property, that's a cost that you have to pay. pay. And of course, the most obvious thing is that it takes a lot more cash to start investing in real estate than it does to start investing in the stock market. I mean, you can start investing in stocks with as little as $100, but if you want to go out and buy a property, you can't do that for $100, at least not a good property. Now, while it's your decision on where you want to invest your money here, here, or here, the idea stays the same, that you need to compound your money. The whole idea behind that is anytime you make money, you want to reinvest at least some of it. That way your money is growing and the money your money made is growing. That way you can grow your money quicker and quicker and quicker over time, because the real secret to building wealth is investing. Yes, we talk about that all the time, but if you really want to grow your money quicker, you got to compound your money, which means you got to have more money in the fire that's burning to make you more money. But I guess if you're burning money, that's probably not what you want to be doing. So bad example, but you got to have more money working to make you more money. Before we get into the next clip, if you are interested in learning more about how you can manage your money the right way, that way you can build wealth, have a financial system, and invest your money, our team put together an amazing guide that walks you through how to do this. You can download this guide for free when you sign up for our daily newsletter, and you can do that by clicking the link up here or by clicking the link in the description below. I didn't grow up learning about money or investing. In my mind, money was something that you go to work to earn, and then it's something that you spend. The whole concept seemed really simple. I mean, in my mind, if I wanted to spend more money, I needed to earn more money. And if I wanted to earn more money, all I had to do was study harder in school and get better grades so I can get a better job. Now, I grew up in a traditional Indian house, and like most brown kids, I was told that if I wanted to become successful or become anything in my parents' eyes, I needed to become a doctor. So when I talk about getting a better job, I mean becoming a more specialized doctor, like a surgeon or something, because now you'll be able to make more money. Fortunately for me, I wasn't smart enough to be a doctor. Now I make money by talking about how I was supposed to be a doctor. But along the way, I started learning about money, and then my mind opened up to this brand new world of investing that I had never been exposed to before. Like, I had never heard of the word investing before this, and now I was learning that you can make money without having to physically go to work, and you can make a lot of money without even being a doctor. So for all you uncles and aunties watching this, yes, your kid can still become financially successful even if they get an A- in math. But before you or anyone can become financially successful, you gotta really start understanding investing, and you gotta understand how to invest your money the right way, which is why in this video, I wanna go over the 5 investing habits that really changed my life. But before I get into those, I need you to do me a quick favor and smash the thumbs up button below. The first thing you gotta do is you gotta stop wasting money when you don't have money to waste. When I was in high school, I worked a couple of different jobs. I worked at Auntie Anne's Pretzels in the mall, and I worked at weddings on weekends, and I was driving a Toyota Solara. And anytime I made money, I would use this money to improve my car or put some upgrades in my car. In my mind, money was something that needed to be spent, and what's a better place to spend your money than your car? And so I was on a mission to have the sweetest Toyota out there. First, I got my windows tinted, then I upgraded my sound system, then I put in 2 12-inch subwoofers in my trunk, and then when I had some more money, I put in some brand new rims. Then the first time I had a few $1,000s in my bank account, I had a great idea. I was gonna upgrade my doors to not open like regular doors, that way my doors on my Toyota could open like butterfly doors like a Lamborghini. And so I found this guy that could upgrade my Toyota's doors for like $3,000, and I got so excited. So I called up my cousin, I told him I was gonna put butterfly doors on my Toyota Solara, and he was like, "Jaspreet, you're an idiot." After I had that talk with my cousin, I learned that apparently putting all this money in my car was a waste of money. Before you spend all your money on things that don't make you any money, like butterfly doors on a Toyota, you gotta use your money to buy things that make you money. The toughest thing about starting to invest your money is finding the money to invest. And you have so many people that will say, "Oh, I can't invest my money because I'm broke." But at the same time, they have the newest iPhone, they have this brand new MacBook, you're driving a brand new car, you have a Gucci wallet, you have a Gucci purse, and you're wearing all these fancy clothes, and yet you don't have the money to invest. Before you can really see any success in the investing world, you gotta stop spending money on things that aren't making you any money, and you gotta start spending your money on things that do make you money. Investments, assets. Everybody at one point or another, you too, not just me, I know you've done this too, have made this excuse that you don't have the money to invest, yet you're still spending your money on something that you don't need and that's not making you any money. You know what I'm talking about. Your BMW, your trip to Cancun, your Lululemon leggings, your iPhone, your extra guac. If you haven't started investing yet, the first thing you gotta do is stop spending money on things that don't make you any money. That way you have money to buy things that do make you money. The second habit that changed my life was understanding that I could live off of my passive income instead of just my active income. Active income is the money you make from your job or your business. So every single day you go to work and you get paid, this is your active income. If you stop working, you stop getting paid. Your passive income is when you make money and now you invest it into these things, these investments, and every month or every year these investments pay you. The nice thing about this passive money is it's passive. You don't got to go to work to earn it. You put your money into this thing and it's going to keep paying you again and again and again. The first real life-changing investment that I made was when I bought this condo out of foreclosure. It was a small condo and I fixed it up and I rented it out. And after paying all of my expenses, this condo started paying me $250 a month in passive income. This was money that I did not have to work to earn because I had a property management company doing all the day-to-day work. And so this $250 was being deposited into my bank account every single month, and this was profit after paying all of my expenses. Now, to be fair, in the beginning of my real estate investing career, it was anything but passive because I had to jump over this huge learning curve because I didn't have any guidance or mentorship when I got started as a real estate investor, and I had to learn everything on my own, and I made a whole bunch of mistakes. But after I jumped over that hurdle, then it became very passive, and this couple $100 was being deposited into my account every single month, and I didn't have to do any work to earn this money. And now my mind started thinking, if I could just amplify this, now I can have my passive investments pay for my life, and now I'm financially free because I don't have to go to work to earn a paycheck because my investments are paying for my lifestyle. At this point, it's all a numbers game. If I can make $250 in profit every month from one unit, if I have 10 units, that's $2,500 a month coming into my pocket every single month. If I have 100 units, that's $25,000 a month coming into my pocket passively that I don't have to work to earn. Now I just got to figure out how much money do I need to get these 10 units or these 100 units, and how do I actually go about doing that? This is where the majority of people look at their money all wrong. The majority of people think, okay, I'm making $40,000 a year from my job or $400,000 a year from my job, whatever it is. Now they're wondering, how big of a lifestyle can I live based off of my income? What I want you to do is think, okay, I'm making $40,000 or $400,000 a year. How many investments can I buy every single year? And how can I live off of my passive income instead of my active income? Because once your passive income is enough to cover your lifestyle, now you're financially free. You can do whatever you want. Your active income is just icing. Now you can use all of your active income and just use this money to buy assets. It doesn't have to be real estate, but you're using all of your active income to buy assets. You're living off your passive income, and every single year your passive income just keeps growing because you're taking your active income and you're using it to pump up your passive income. This is how wealthy people look at their money. The reason wealthy people make so much money is not just because they have a big salary, it's what they do with their money. The richest people don't make their money from their jobs, they make their money from their investments. And so what you ought to do is you got to start thinking like a wealthy person and start building up these assets and start building up these investments. That way now you're creating this passive income. Yeah, you're not going to make $1 million a year from your passive income in day one, but maybe you can start with $50 a month or $100 a month, and then you can start slowly building that up to now a lifestyle where you can live off of your passive income. There's a lot of different ways that you can do this, and I made a video on YouTube where I went over 25 different passive income ideas. If you want to watch that video, I'll link it for you in the description below. The third investment habit that really changed my life was understanding the value of my time. Growing up in a traditional Indian house, I learned to be very frugal. And as somebody who is frugal, you start to think, why would I want to pay somebody else to do something when I can just do it myself and save that money? When I started off in real estate, I had to decide, was I going to manage my investment properties myself, or was I going to have a property management company do it for me? Property management company's job is to make sure that your investment is completely passive. So they're doing all the day-to-day work and they're making sure you're getting paid. If you don't want to pay them, then you can do the management work yourself. It's just not as passive because now you got to make sure the tenant pays you. Anytime the toilet breaks, you got to go out and fix it, or you got to send somebody to fix it. And so you got to be more involved if you're going to be the manager yourself. If a home rents for $1,000 a month, a property management company is going to take $50 to $100 every single month to manage this property. But if I just do it myself, that's more than $1,000 that I can keep in my pocket every single year. But what I'm not valuing is my time. Because yeah, if I manage it, I can keep another $1,000, but I lose out on all that time. This is where I had to really dig down and ask myself, do I want to be in the management business or do I want to be in the investment business? Because if I want to be in the management business, then now I am paying myself an hourly fee to go deal with the tenants. But if I want to be in the investment business, now my time should be spent finding more real estate investment deals. That way I can grow the pot instead of just trying to figure out how I can cut some pennies out of my expenses. Time is your most valuable commodity, and it's the only resource that you cannot create more of. You can always get more money, but you cannot get more time. Once I started thinking like that, I stopped wasting money on things that I could hire someone else to do. That way I could focus my time on things that are going to bring me more value and make me more money. I don't manage any of my real estate. I hire a property manager to do that. I'm a licensed real estate agent, and so So I can find real estate deals myself and I can write out the contract myself to buy the deals, but I don't want to spend all the time writing these contracts. So I partner with another real estate agent who splits the commission with me, and I just go find the deals and I tell them the offer. That way they do all the busy work. And I have multiple virtual assistants. That way I have other people managing my days and my emails. That way I don't got to worry about doing that. If I'm spending my time doing something that I can delegate or pay someone else to do, then I am wasting my time. I want to spend my time doing the things that are going to be the most valuable to me and do the things that are going to give me the best return. These are things that only I can do and no one else can do. Everything else I want to delegate to someone else. The fourth investment habit that really changed my life was understanding the long game. I think a lot of people, myself included, who get started investing kind of follow a similar plan. So you hear about this whole idea of investing and you get really excited, and then you start investing your money, and then you start hearing about these cool things like trading and day trading and penny stock trading, where you can make a lot of money very quickly. And so now you go from this idea of investing your money for the long term to build wealth to now trying to make this money almost overnight by trading your stocks into these riskier things that will hopefully make you money very quickly. That's when I got into day trading, and I was spending all of my free time looking at the stock market, trying to buy things and sell things and buy things and sell things and buy things and sell things. And I was always kind of living with this anxiety because I was just constantly staring at the stock market. And that's when I started to realize that this wasn't working because, well, I wasn't making any money. The investors that make the most money are the investors that play the long game, because now you have time on your side to let your investment grow and compound and make you more money. The reason why this is so hard for so many people is because it's not as cool or as hot as trying to be a trend investor, where now you're investing in the hot stocks that are booming right now and you're investing in all the names that are always on the news. But that is temporary. I mean, these are just trends. What's popular today might not be popular tomorrow or a year from now or 10 years from now. But if you're investing in something for the long term because you believe in the underlying value of this company or this investment or this asset, now you just want your money to grow and compound over time. My favorite place to invest my money is real estate. So I'm always looking for more real estate deals, but I also have some money in the stock market. And the way I invest my money in the stock market is a couple different ways. One, every single month I have an automatic deposit where some of my money automatically goes into the stock market, into a few funds that I want to hold forever. And then I have some money in the stock market that's kind of like my more fun money, where I'm investing in more speculative things and more growth things. And this is money where I can be a little bit more active with. But the most important thing is you got to have that money to go towards the long-term investments that's just automatically happening, because that's where long-term wealth is built. I'm also a money nerd. I like researching companies, and I think I'm pretty good at it. I like reading financial statements and cash flow statements, and I like to study how companies are doing, which is why I also have the kind of fun money, if you want to call it, in the stock market, where I'm investing in individual companies that I think are going to grow in the future. You have to know yourself as an investor, and you got to know what your goals are, and you got to understand that the big money is made over the long term. And the fifth investment hack that really changed my life was understanding the value of learning. I went through these like weird phases in college, because in the beginning of my college career, I thought that college was necessary to become successful, and the better you do in college, the more money you're gonna make. And by the time I was leaving college, I was like, this is so dumb. Why did I spend all this money in college? Because I'm never going to use my college degree. Now, college has its place. I learned a lot in college, but the things that I learned in college were things that I found outside of my classroom, because I started a lot of business and started investing in college. And so that was really valuable for me. And so there's a lot of value in college, but this is where I started to have this kind of real debate into the value of education. Your education is the backbone for your success. But the thing that a lot of us get confused is we assume that education means college. But there's so much more to education than this college. And you have to have a good education if you want to become successful. But this education can come in the form of real life stuff, not just in the classroom. I learned how to be a good real estate investor by screwing up as a real estate investor. I talked about my worst real estate deal ever on YouTube, and this was the deal that cost me the most money, and that was the deal where I learned the most as a real estate investor. If I got defeated and just started crying after that deal, then I wouldn't have gone anywhere. But I used that experience as lessons, and that taught me to be a much better investor. That way I can do bigger and better deals now. If you want to watch that video, I'll link it for you in the description below. I listen to books every single day. I don't like reading, so I listen to audiobooks. I learn from YouTube videos. I buy a bunch of online classes, and so I invest a lot of my time and money to learn. If you think you know everything, then chances are you know nothing. If you want to keep growing as a financially educated person or as an investor, you have to constantly keep learning. This might not be something you learn in the classroom, but these are things you can learn outside of the classroom by doing and by learning and by reading. So the 5 investment habits that really changed my my life was 1. Stop wasting money when you don't got money to waste. Understand that you can live off your passive income instead of just your active income. 3. Understand that you gotta value your time. 4th, you gotta play the long game. And number 5, you gotta always keep learning. If you enjoyed this video, here's a video on passive income that I think you'll love, and while you're at it, join our free finance and business newsletter, and as always, keep hustling. Then when people buy candy, they buy pop, they buy these things from your vending machine, then you will get a percentage of the profits. Your job is to make sure the vending machine is full and make sure that you're getting paid. The nice thing about the vending machine business is